know who I am. I know I'm important. Like, I know my worth. I ain't gotta walk around thinking I'm bigger than nobody. The only person I'm trying to be bigger than is the person I was yesterday.
I think you just gotta know what you stand for and know what you represent, know what's true to you. Because you can't please everybody, you can't be everything to everybody, but you could be true and you could be yourself and comfortable in your skin and just represent what's real to you.
I'm very much in a space right now where I'm not doing anything that's going to compromise my peace and happiness. So I think just taking control, making sure you maintain your power, don't give your power away to anybody. That I feel like is the key to truly being happy.
Hey, bro, you better get ready to buckle up because this shit don't get no easier, bro. What, you think the grind gets easier? Come on, bro, you silly, man. This grind's only for the strong ones, bro. And if you weak, I suggest you go ahead and leave. It's tough, but it's true. Be safe.
Know who I am. I know I'm important. Like, I know my worth. I ain't gotta walk around thinking I'm bigger than nobody. The only person I'm trying to be bigger than is the person I was yesterday.
What's happening, everybody? It's your boy Creative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now today, I am super excited what I have planned for y'all. We're going to be breaking down slippage, right? And what is slippage? Slippage is what you pay. It's the actual cost of what you pay when it comes to option contract trading, right? Here at Creative Coder, our aim is to be able to create different option algo strategies, AI agents, and infuse that with a little bit of machine learning, right? I've been doing this since about April of this year. It is 2025. I don't know when you're watching this. And it's December now, right? So it's about 10 months that I've been doing this, and I've been streaming this with y'all for the past 6-7 weeks now, right? So this is my process when it comes to being able to understand different theories and theses of this algo world. So today we're going to be breaking down slippage and why you should care about it. I'm going to be using Claude Code in order to do this. Now, I already began a session. I'm not going to hold you. So y'all are already, you're just catching me midway, like a quarter of the way. I wouldn't even say mid, a quarter of the way there with regards to being able to continue this along. So if you haven't already, I need you to like and subscribe. So let's go ahead and jump on in. So again, I've already started this, right? So there's some work that's already here. So what is this based off of? Now, y'all remember previously, I was like, yo, y'all should really tap in to Google Scholars, right? Google Scholars is definitely legit. I was spending some time on Google Scholars, and I want to find the exact one. Right. So we can really spend some time on this. Hold on. My fault. Give me 1 second. Here's Google Scholars. And I need to switch the screen so you can actually see it. Google Scholars. What is it? What is Google Scholars? It is a place where academics developed or published, their theses papers. It's not only where, but Google Scholars is a place where it aggregates it, right? So it brings it all together from different universities, right? From different countries, and allows us to be able to read their theses or their understanding of whatever they're covering, right? So lately I've been spending a lot of time here just to be able to understand option contracts a bit more. So I'm not going to hold you. Like when it comes to trading options, I mean, who hasn't been doing that? I feel like everybody has Robinhood or Webull in their pocket, and as soon as you have that, and everybody has been getting into option trading a little bit more, right? Now what separates me and us, right, because I'll put myself in that bunch, is that these are academics that spent 10, 15, if not 20 years researching a topic, right? Today, what we're going to be talking about is option contract slippage, right? So what I'm going to do, again, every time I come here, I'm looking for the PDF just to make sure that it's a document that we can download. So it is beautiful. Verified human. All right. So here it is. It is 47 pages long, Wolves. If I was like, all right, let's go through it, right? But I've already read it. I've already gone through it. And what we're going to do is break this down. And slippage, the choice of market or limit orders in future trading, right? The professors or the individuals who wrote it are Scott Brown, Timothy Couch, and Eric Powers. And this was published back in March 2007 from the University of Puerto Rico and the University of South Carolina. And the authors, and this is their thank you note. So this is a real deal academic paper, right? And what we're going to do is base our conversation or this stream today based off of this paper. So let's go ahead and jump back into Claude Code. Now, again, I told you I began a session. So I just want to jump back into that because I want to explain what's going on here. I want to explain what this is, right? So just follow me. If you do have any questions, please make sure you ask them. So what I'm going to do, just so we can set the stage, right? Can you explain like what slippage is and what exactly are we doing here? Again, I've already started a session, so I've already like kind of went through all of this, right? But again, I want us to be able to go through it so we can catch up. And then once we catch up, we're just going to keep doing the work here. Because I was about to continue, but I was like, you know what, this would be something great to stream. Because everybody has an opportunity to be able to learn from each other, right? So what is slippage? Slippage is the difference between the price you expected to pay, right? So when you actually submit an order, you're just like, all right, I want to buy this option contract for $10. But the order fills, right? It filled for $15, right? So that $5 is going to be the slippage, right? So here's an example. An option was quoted at $100, $100 for the bid, and $110 for the ask. Now, the way that I like to think about it, when you want to get into the market, you have to ask it to get into the market, right? So this is what you're going to pay, right? When you want to get out the market, you're going to bid in order to get out the market, right? And the mid is going to be the halfway point in between this 105. We got filled at 108, right? The slippage was 0.03, so 2.9% loss before trading even starts. So that's why I want us to really focus on slippage, right? Because our signal could be great. Our exit could be fantastic. And remember yesterday we covered the exits extensively with being able to use relative skewness. And if you haven't checked that video out, I would definitely recommend you go check that out. But using relative skewness definitely creates an edge or adds more alpha, to a strategy to allow it to be able to, adapt to the market. What we're talking about today is slippage, right? So we have a loss. I really want this to be able to bake this in, right? So if you don't take account for slippage, you're going to be behind before trading even starts based off this example here, right? We got filled at 108, right? So the slippage cost was $3. So we have almost a 3% loss before we even start trading. So what we're doing is we're building a slippage measurement system using 5 years of real SPY option data, 102 million trades, right, to validate the academic claims on the paper. Now, I told you what the paper we're using, this paper here, right? It's 47 pages breaking down the slippage and the choice of market or limit orders in futures trading. When you're talking about futures trading, you're talking about options, right? Here's a little bit more about the abstract. So I'm not going to insult you and make it seem as if you can't. Hold on. Here we go. For those that want a little bit more on the abstract, so here is it. Let me just zoom out a bit because I think that's egregious. There we go. I think you can still see it. So here's a little bit more on the abstract. So let's go back to our work, right? Quantify the cost. So how much this slippage actually cost in 0 DTE options, and these are option contracts that expire the same day. And these are option contracts primarily where we build our algos based off versus long dated options, right? We're going to build rules for our robots, right, for our algo bots, and when should they use limit orders versus market orders. We're only going to use limit orders. Well, market orders is going to be on the extreme case, and this is how I like to look at it, right? If you are paying what the market dictates, sometimes we're going to overpay and sometimes we're going to leave money on the table, right? So that's why I would like to limit that, right? In order to say, okay, you know what, bet you're asking for 110. That's kind of high. Whoa. So what I'm going to do is I'm going to give you 108 or 105, right? I'm going to try to get filled at the mill, because the closer that I can get to like 105 or 108, 107, right? That makes my fill, that makes my entry a lot better, right? So we can take care of this slippage, right? The data that we have, we are using SPY, and the reason I'm using SPY is because SPY is one of the most liquid contracts, or excuse me, ETFs out there. SPY is the S&P 500. It is the top 500 companies within the New York Stock Exchange, and I'm using the 0 DTE. We talked about that. These are option contracts that expire the same day versus long dated options. I'm talked about while we're using SPY. The only thing I want to clarify now is, all right, we just downloaded the 2020 data because that was topic of conversation. I needed to get the 2020 data. So the way that I got this data was a little different. I know I've been talking mad trash about them, but this is IBKR. I use IBKR in order to pull the data. Reason being so is because as long as you have an account with them, they allow you to be able to get data for free. I think you have to have it funded. Don't quote me on the amount. Believe you have to have the account funded. And they give you access to paper and live trading. The only reason I don't like IBKR, I mean, if you're using 1, 2, 3 bots maximum, Gucci, you're fine, right? But I run multiple bots, like 15 bots sometimes at a time, right? So that's why IBKR just really didn't meet my needs, and I had to switch over to Alpaca. But I still use it, right, whenever I need data, because again, they provide comprehensive data. So this is the data that I pulled from them. This is SPY for 2020, and I needed to grab this data so we can complete our 5-year data set. I had everything, but I thought I grabbed this before, but I guess I didn't. So what I want to say is, where is it? I don't know why, but I put it over here. All right. What I legit need to do is move it here. So if I can, all right, hold on. Let me just do this. All right, bet. Now we just downloaded the SPY data needed, 2020. Here it is. We need to create the Parquet files like the others. See, boom, and make sure in the same path and directory as well. What I'm going to say, I want you to use the conda environment. What is a conda environment? A conda environment is where you can keep Python packages that you're going to need in order to complete a series, an exercise, a file, whatever this is. Right now, I'm using AlgoBaby, and this is where I keep anything pertaining to options, machine learning, right? I keep it in this particular conda. It's like a garage that I keep tools in that I'm going to need. So whenever I need the Claude code in order to use these tools, I say, bet, use the conda environment. So it makes it a little bit easier so it doesn't have to go searching for it. So we can create the conda, excuse me, I'm saying conda, the files before we proceed. Well, all right, bet. So what we're going to do right now is we're going to convert the open, high, low, close data that we just downloaded for 2020. And I used the IBKR to do that. Now that I've kind of showed you that, I can close it, because IBKR, one thing about them, they will use a shitload of memory, fam. And I don't need it open. So let me just go ahead and close it. So what's going to happen right now, I'm having Claude Code convert the CSV file from CSV to Parquet. And the reason I need that is because Parquet files are a lot easier for computers to read and a lot faster, right? So that's why I'm having to do it. So give it, I want to say like another minute or so. And that's going to be completed. And if you all do have any questions in the interim, please let me know. All right, matches. Let me make sure. Bet. Double check and make sure ready. All right, let's see. Oh, minor difference is the 64. Okay, let me fix it. So it's a precise match. Go ahead, well, get me right. All right, beautiful. All right, now that we have the data in order, let's walk through how we're going to create this file so we can test this. Y'all, while this is doing, I'm looking at the live market right now because it's still open. QQQ, and I have a strategy that I've been wanting to test out, but maybe I'll do this later with y'all. But QQQ's been popping. I'm not going to hold you. I'm looking at it on the 1 minute chart. Oh shit. I'll come back to this. Let me just finish. I'm looking at it on the 1 minute chart on TradingView, right? Each one of these candlesticks represents 1 minute of action. The green is going to be the bulls. They want the market to go up. The red is going to be the bears. They want the market to go down. And I'm using the Bollinger Bands, right? The red band is going to be the oversold line, right? Or, yeah, overbought, excuse me, line. The middle line is going to be the moving average, and that moving average could be EMA, SMA, DMA, TMA, whatever your heart desires. I normally use SMA or EMA. And then this bottom line here is going to be your undersold line, right? Or your oversold line, excuse me, right? So what normally happens is that whenever we see the bars, right, or these candles start to creep up above this line, the reason I love using Bollinger Bands is because you can actually see it in play, is that, yes, the price is going to stretch, but it's always going to go back to its average. Not always, but a good majority of the time, right? See what happens here? It crossed the oversold, and guess what it did? Found its way back to its average. It crossed the overbought. Guess what it did? It's found its way back to its average, right? And you see this whipsaw here? QQQ's been popping today, right? And what is QQQ? QQQ is the top 100 tech companies within the NASDAQ, and they're a lot more volatile than SPY, right? The liquidity is not going to be as tight or as high as SPY is, but we are going to get to testing that as well because I do have the data for QQQ, so stay tuned. All right, this is a script that's going to measure real slippage from 5 years of SPY option trades and validate the paper's hypothesis. The input is going to be the trades, the fill, the bid ask price. Remember, you when you want to get into the market, what do? You pay the ask price. So you ask when you go over somebody's house, right? Before you go over, what do? You normally, some people just don't. They just like to show up type shit. Be like, yo, I'm outside. What the fuck? How did you know I was home? How did you know I was even here, bro? Like, what? And then the bid price is what you're going to pay. We want to get out of the market, right? The size and the timestamp. We're going to use IV, or implied volatility. IV lets us know how expensive the option contract is going to be, right? Delta is one of the Greeks for the underlying option contract. Delta lets us know for every $1 movement, what does the underlying option contract do? And then the underlying price, and then we're going to use ATR, or average true range. This is our volatility proxy in order to gauge, all right, how can we, yes, we understand that slippage a thing, but how can we control for it as much as possible? So remember, in this paper, there are a few different ways that these professors have decided to be able to control for slippage. And I was going to say one. Again, retail traders bear the risk that price that they actually receive will differ from their expected price of the initial trade, right? So this is the main thesis, right? That I'm looking to be able, not necessarily to help, use this paper so I can, number one, solve for, right? But also make sure that no matter the strategy, we're able to control for it as much as possible, right? My fault. My fault. There we go. You gotta stop clicking. Be clicking around. All right. The core calculation. Sentiment segments to analyze: time of day versus mid and close, DTE, 0 DTE, 1 to 7 days, right? So daily, weeklies, and then plus. So anything higher than weekly, so semi-weekly, semi-monthly, right? 2 weeks, a month out, 6 months out, a year out. Now, one thing just to keep in mind, every time you add a day, you're paying for time with options, right? So that's one of the things that you're paying for, right? That's the extrinsic. There's intrinsic and extrinsic. I'm going to get that to you. Hold on. Order size, one contract versus 10 versus 100. And remember, with every contract equals 100 shares. So this is going to be interesting to see how that plays out. The spread width, tight versus wide, volatility regime, and we're using ATR in order to figure out that. And then moneyness, right? How close are we to the current price? ITM is going to be very close to the current price. ATM is damn near the current price, right? When you go to the ATM, what do you expect to grab? Moolah. So think about it that way, right? So ATM, you're already printing money, and then OTM as far as the what they say, BFE, that's OTM. It's just out there, bruh. All right, summary output per segment, the mean and median slippage, the slippage standard deviation, the trade count, and the correlation. So single file or modular, one script. Yeah, I want one script, bro. We want to have one script, one file, not multiple, in order to do this. And we want to do it year by year. But also have the option to do 2022 and 2023, right? Multiple years that we can indicate. 3, all of the above. Now we want to use Polaris, DuckDB. Now these are Python libraries that I found to be a lot more faster, right, than just using pandas. And what is pandas? So pandas is the Excel for Python, right, for lack of better words, and then Polaris is just the faster version of it, so it can work with larger data sets. Right now we have a data set that's over 102 million type shit, right? So I want to use the best thing in order to do that. So partnering these two is allowing us to do so. Let's run a few terminal commands so you can understand how to do it before we proceed. Well, use the conda environment. I think I already gave it to it, but I mean, it doesn't hurt to be able to say, you know what? Back up. How to bet. DuckDB is in there. Polaris is in there. Don't try me. DuckDB and Polaris is in there. Whoa. Verbose is more logging, so it can see the feedback, so it can confirm that it already satisfied. Then I tell you, why are you arguing with me? You doing something wrong. Y'all doing something wrong, fam. Didn't I tell you? Stop arguing with me, man. Flibbergibberty. Okay. If I was using pandas, I still would have been waiting. There you go. There you go. Slippage calculation, yeah. You can still use Pandas TA. It's Pandas just with the technical analysis indicators to see if this will work as well, along with using Polaris and DuckDB, so we can ensure it doesn't take forever to run these tests. What am I looking for? This one. Beautiful. All right, all three work. So Panda, TA, pre-compute, ATR on stock. Okay. I love it. DuckDB, and then Polaris. Okay. All right, well, let's get this done. Create the file here. Slippage. And let's make sure that the output is simple enough that for anyone that hasn't traded before or used algos can get what we're doing. Do not assume anything. Explain everything in the output and logging. Well, let's make it very UX UI friendly. We're going to run it in the terminal. Let's proceed. Let's get it, shouted. We getting work in, man. We getting work in. The slippage dictionary was already there, bro. Like, you ain't need to do that. All right, let's get right. I already showed you what that was. Now we need to get into the slippage dictionary. Beautiful. Let's go ahead and hit Conda, activate. Algo baby. You know, it went from base to algo baby. Now I know we Gucci. It's creating the file. And then once we have it, I'm going to run it. Then we're going to review it. And then we're going to be building stuff off of this, right? So it's just not being able to prove the theses within the paper, right? But also being able to apply it to real back tests and see how well it's going to work, right? And I'm going to kind of combine both of these, the slippage analysis that we did yesterday, legit, using realized skewness. And then we're also going to be using the slippage finding here in order to build on our work. So I appreciate y'all, fam, for sticking around, for being here. If y'all do have any questions, let me know. But nonetheless, let's continue this work. I'm super excited about this. I was trying to do two things at once, but we're Gucci them. Super excited. We are Gucci them. You know, let's go take a peek at the market real quick. Let's see how the market closes. Wow. Oh, never mind. I don't even need to fill time. It's right there. The different slippage. What's the difference between? Let me just go to that because I love that. What is slippage? Slippage is the actual difference between the price you expected to pay, right? When we found the signal, it's like, all right, oh shit. Look at this. I thought it was going to close on a bear decline, but the bulls came in and said, you know what, hold my bag, fam, and they just crashed through the overbought line. So whoever is buying this to be able to like sell at market open tomorrow. So this is crazy. I mean, the bears are trying to push it right back down, but as you can see, it's still above the overbought line, and this is crazy. And I am seeing rejection, right? Rejection that even though the bears are trying to push the price down, whenever you see those wicks pop out there, that is firm rejection, right, of the support lines. What is support? Support is, did I tell you it was rejection, right? The bull step back in. It's like, bruh, did I tell you to back up? Right? Again, now we're seeing rejection of the resistance line. What is resistance? Resistance is the higher high, right? So the bulls are trying to push the price this last couple of minutes in the market. Well, this is interesting, man. So let's see if they can keep climbing that ladder. All right. Y'all just want to watch this? Okay. This is exciting stuff. That's what I kind of like. All right. So let's get back to the task at hand. What is slippage, right? So the slippage is the price that the difference between the price you expected to pay and the price that you actually paid. So the example, an option is quoted at a bid of $1 and an ask of 110 and a mid of 108. You buy at 108, right? A mid of 105, excuse me. We bought at 108. The slippage is 0.03. We paid almost 3% more than the midpoint, right? So why does it matter in fast market? Then I said, bro, look what it's doing, fam. Look what it's doing. Bulls are not just stepping up, but there's like, cause the bear stepped in for a little bit, but it was like, bro, back. I told you we got this, so let me take care of this, fam. I told you we got this. And I'm going to create an episode one day or stream it one day where we can actually break down these candlesticks, so y'all can understand what I'm talking about. So we can all be in unison with this, right? Because this is dumb crazy right now. That they're maintaining resistance, right? That they're maintaining this overbought level right here, and the the bears were not able to crash it back down to its average. So remember when I told you, and the bands are just getting super wide right now, and you see it's extracting, right? It's like, bruh, I'm going to the heavens right now. So just, if you're gonna catch on. This is maybe a little play. Like, if you should have got in right here, if you would have got in right here, or even here, right? And just remember, each one of these represents 1 minute. So 1, 2, 3, 4. You would have been patient. 5, 6, 7, 8, right? You would have paid out. Crazy, right? Look at that. And it's just, I wonder what SPY is doing. Let's go take a look at SPY real quick. Let me see what SPY is screaming. It's not as exaggerative, right? It's not what SPY is, a little bit more diverse than QQQ. QQQ is straight stocks. Straight tech companies. So if you're holding like an Nvidia, an Apple, a Facebook, a Microsoft, right? I'm not saying it's either one. It can be. It's an amalgamation of those, right? It's a diversity, right? It's an ETF. So an ETF is hold on. Y'all seeing this? An ETF is, imagine a quilt, and each patch of the quilt represents a different company. And this particular ETF has 100 different, okay, the bears just came in and just said, bruh, hold on. The market closes, never mind. We're seeing live how the last almost 5 minutes is a straight rally, is a straight bull rally. And this is something to study, right? This is how algos are created, right? So it's just not all I want to create a bot, right? But you got to understand what the market is doing, right? And it just crossed back in, right? So it's crashing through. It was trying to make new highs. Now the bears stepped in. It was like, all right, for this last 30 seconds here, it's a massive sell-off. And the reason it's a sell-off is because whoever got in here, they already made their money, right? It was like, all right, I want to make my money, and I'm just going to sell. So it's a massive sell-off occurring right now. And I understand it. Look what happened. Right, if you'd have got in here, or even got in here and been patient, right, you went up. Damn near massive sell-off happening right now, and that's okay. It's just reverting back down to its average. It was inflated for a bit, right, and we're just seeing a massive sell-off that's being rejected because the bulls are trying to come back in and push it right back up. Let's see how it closes. Do you think it's going to close on the bull side or the bear side? I think it's going to close bears, right? Because the sell-off is real. You made your money. Why am I holding? I made my money. Market just closed. Did I tell you? All right. That was exciting. Nice little commentary. Nice little color commentary. All right. Let's go ahead and run our script. Python. Beautiful. All right. 2024. We're analyzing the data. We're querying the data. Right. This may take a moment for large files. Perfect. I understand that. Thank you for letting me know. Right. That's that user experience, the user interface I was talking about. ATR mean is 0.2218, and then the high volume threshold is 0.34. And these are numbers that we got from the paper, and we're using a 10-minute ATR. So we're taking 10 minutes of data in order to accurately get the ATR, the average true range. Where did massive sell-off here, bro. Sell off both places. That's crazy. But the sell-off in QQQ was worse. Not worse, but more violent. I'll just say that. Look a bit more, but that's fine. All right, so we're just gonna give it a bit, yeah. It is pulling in all of 2024 data in order to give us the info that we need in order to get the slippage down right, yeah. So if you do have any questions as we're working through this, please let me know. In order to, yeah, I thought using must suck in, maybe not. I'm trying to figure out what's taking it so long. I was chatting mad shit, bruv. I thought Polaris and DuckDB were like gonna fix these issues, but shit, I feel like it's taking damn near longer. All right, bruh. I should have just used pandas. Bruh, this is ridiculous, bruv. You know what? I'm gonna vectorize these operations. So I think what's happening right now, the operations are being done sequentially. Putting it in a vector just means I'm going to make it done a lot quicker, fam. Okay, I was about to say if you want to freeze and shit, review, and we notice that it is taking a bit longer to run. Are the operations being done within a vector or not? Explain what a vector is and how it works. Advise before updating file, and what other bottlenecks could there be? There hither. I thank you for stopping. Right. What is vectorize? A non-vector operation. Loop through each row one at a time. Vectorize. Process all rows once using the CPU memory efficiently. Then think of it like non-vectorized is carrying groceries one at a time. Vectorized is carrying groceries in one trip, right? Who wants to do it one at a time? I got to go back to the car. The current bottlenecks, loads the results, fix, compute ATR. Okay, use loading all 23 columns. We need 10 columns. Select only the columns we need. Let's double check the columns that we need. Then run a few terminal commands to test this theory out. And can I spell theory right? Out, and make sure it works well before we implement it. Make sure this works for me, homie. I didn't want to cough in your ear, so I had to like, you zill me. You zill me. Get me right. Now let me test DuckDB aggregation directly without no loading into Polaris. Why are you loading it into Polaris? Oh. There's a way. I saw I made you do this before, bruh. So like we can actually figure this out, bruh. Cause right now you're making the people them wait, man. We still would have been waiting if I was running that damn test. Yerp a derp. Like this is a good time to take any questions. Y'all trying to figure out what I'm doing. All right, here we go. Let me import DuckDB, import time. We're loading the data. Here's the path. We're gonna print result. Okay, auto pruning test. Here we go. Get me right. Test pull data into Python. Run 1 million required aggregates into DuckDB. Simple ag test, just a mean. DuckDB auto pruning columns only reads with the select where. 7.85 seconds for the 402 million rows with the time buckets. That's acceptable. Yeah, that's a little bit. Push all the aggregation into DuckDB queries and return only the summary tables, not the 120. Okay. Make sure we're not losing any data or information we need that could invalidate what we're doing. Well, then once confirmed, proceed. Shall I proceed? Yes, indeed. No, I figured out the other day too. All right, bet. Give me the great news. Give me the great news. We are Gucci them. Review. All right, bet. Give me the review. All right, here we go. Here we go. On pins and needles. All right, since you bullshit, let me go ahead and take that away. Until you're actually ready to go create. Let's make sure we're not losing any of our data, fam. Validate DTE, dates expiration. Get me right. Interesting. 2024 only has 0 DTE. I mean, most of it is going to be 0 DTE, fam. So I believe the data is 0 DTE only. This is intentional. The files 1 minute 0 DTE. This is actually perfect for our slippage study. 0 DTE is where slippage matters the most. No shit, Sherlock. All right, come on, Holmes, get me right. Proceeding to update now. Preserved. All 6 buckets, some matches. All 5 buckets, correct. Both preserved. Trade count integrity, all across groupings. Key discovery. Data 0 DTE only. Sherlock. Perfect for our use case. Holmes. No 0 DTE bucketing needed. All trades are the same day expiration. No data loss. Ready to refactor for speed. Proceeding now. Perfect. So what we're doing is we're creating a file so we can test our actual slippage theses that came from these brainiacs over here, right? So I'm not going to take any credit. These brainiacs were able to come up with an idea that we're testing now, right? So where did I get this information from? I got it from Google Scholars. For those that don't know, Google Scholars is a place where you can go in order to find academic research paper, case law, right? I primarily use it for options, 0 DTE specifically. And what I did was put option contract slippage. The reason I want to focus on slippage is because that's one of the items that goes overlooked when it comes to building out an algo. Shit, I'm not gonna hold you, even I did it, right? And I want to do a better job in order to account for it. So I want to go to some brainiacs that actually know what they're doing. These gentlemen over here, not always men, sometimes it is women. Not going to hold you, don't want to be sexist there. These individuals here were able to study this for a period of 8 years, right? So they can understand slippage and the cost of, and the choice of market or limit orders in future trading, right? So what we're doing is taking their theses and being able to test it in actual code. I thought it was going to be one of them. It was like I got to sneeze, but it ain't coming, but it just right away. All right, here we go. For analyzing the data, we're computing the overall statistics. We're running it on 2024. Slippage measures the hidden cost of every trade, right? All right, beautiful. The overall slippage, more or less, you paid versus the min point, positive, overpaid, negative, underpaid, 0, perfect. So time, the paper found that slippage is higher at market open. Let's verify. So the mean, the median, and the average, and then the total trades. Looking at the orders that should have more slippage, harder to fill looking at the orders. So 1 contract, 2 contracts. So how many contracts, right? And then slippage by spread. Wide slippage equals more room for slippage. Does fill actually qualify? They differ. So call versus puts. Do calls and puts have different slippage? Okay. Key takeaways. Avoid the first 15 minutes. Typically have the worst slippage. Consider delaying entries until 9:45 or later. Size matters. Large orders get worse fills. Wow, okay. Slip large orders into smaller chunks. Spread is your enemy. Widespread equals guaranteed slippage floor. Skip trades where spread is greater than 5%. Use limit orders. Market orders gives you the worst case. You always use a limit order, even if slightly aggressive. Negative slippage exists. Some trades feel better than mid trades. This is because more liquidity, right? Tight spread conditions. All right. So let's take this under consideration. So one thing I guess I'm taking from here is that, and I never use market orders, is limit orders is your way to free the game. All right. Review and let's discuss what is the takeaways here. Then let's update to run on 2024 and 2023 collectively. What I actually want to see is like, I mean, I guess it is doing it, but I actually want to see the slippage on a CSV or a file that we can actually review. Our output got truncated. There's a display issue. Let me fix it and run it on 20. The code looks fine. The output truncated the terminal display. Okay. All right. Let me actually, this is one of the first few times I let Cloud Code dry the boat. So I'm going to let him dry the boat real quick, and it should take under 3 minutes. And if it doesn't take, if it takes more than 3 minutes, then everything that we just did was for shit. Right. So it's going to analyze 2023 and 2024, basically what we did here. But I wanted to get more data so we can actually understand the impact of slippage throughout the years. Then what we're going to do is quantify that a bit more, and then create a function / method that we can actually add to a back test and see how we can further validate or invalidate this thesis, right, that I was able to get from these gentlemen over here. And this is paper from Google Scholars, right? And I took this paper, digested it a bit, right? It is a bit of a read. I'm not going to hold you. It is 42 pages. What you can do is one of a few things. You can either use AI in order to break it down, but again, they can hallucinate. So what I would do is just break this down, fam. Every 5 page, right? Take a breather. Even though it is straightforward, easy to read, sometimes it should just go from elementary to PhD real quick, right? But it is a good read. If you want it, I'll just share it here in the chat here, so you can actually read that for yourself. Yeah. Oh shit, it's not gonna let me share it. Well, I'll figure out a way to share it if you really do want it, and so y'all can have it. Okay, hold on. I can stop talking. Our code just finished. All right. Open is worse as slippage. Okay. Versus afternoon confirmed. Large orders equals more slippage. 1 contract. Point negative 100 contracts. Oh wow, this is the opposite. Large orders equals better fills. High volatility equals more slippage. A wide spread versus very wide spread. Opposite. So surprising findings is that the negative slippage is common. Average fill is better than mid. Bigger orders get better fills. The market makers give price improvements to attract flow. The very wide spreads equals the best fills. What this means for bots is from 9:30 to 9:45, pay more, avoid or use aggressive fills. We're going to stay safe. And then best time to trade. I'm not going to agree with that. If you're talking about, I'm not going to agree with that all the way. And then great fills. All right. Yes, one little caveat is this paper was from 1990 to 02, right? Modern technology has been improved a lot more since then. So I can understand where they're coming from then. I was just trying to adapt it for modern day. All right. Let's run it on the full 5 years so we can get an account before we proceed with back testing this in an actual strategy. So I'm going to show you the back test that I'm going to use after it shows me that it can comprehend what I needed to do. All right, we're running it so before I just ran it. This is just 2023 and 24. Now we're going to do all 5 years so we can get like truly an account of what slippage is telling us for the past 5 years. Now, what is the past 5 years, right? You got COVID in there, right? So take that into account. You also have inflation, deflation in there, right? So take that into account. This is the U.S. stock market, right? Global is a little bit different. So I'm just taking into account the U.S. stock market. What else you have in there? You have bank failures in there that happened in 23, right? Right now we're kind of, I don't know what to call right now. It's like uncertainty to the max, right? There's going to be moments where it's like super good and the market is treating us very well, but there's also going to be moments where they're super choppy, right? So right now I'm kind of, it's almost like a toss up. I'm interested to see how the market closes next week, and I'm really interested to see to be able to get my hands on the data for full 2025, and we're going to break it down live, and being able to see what the year done, the year review type shit. But nonetheless, what I want us to be able to understand with this is, number one, get as much data as possible so we can understand how slippage works. Once we understand how it works, then apply that to our back test. Oh, what I was going to say is that I actually want to run a back test so you can see it. So let me get a little basic back test. This back test here, it uses DMA and the bear bull power, right? This strategy is a basic DMA crossover. DMA is a version of the moving average. It is twice as fast as the EMA, and then the bear and bull power allows us to know, okay, which selling pressure is under control, right? Is it the buyers, right, the bulls, or is it the sellers, the bears, right? So let me just go ahead and quickly run this strategy so we can see the impact of it now before we actually add the slippage. So all of our strategies start at $100, right? Oh yeah, you're right. You're right. So Conda, activate. Algo, baby. Beautiful. Run it. So all of our strategies start at $100. And what I want to show y'all right now is what the strategy is done, or where it's at, before we even add the slippage account that we have done. Are you done? Yes, you are. Here we go. We have full 5 years of data, ladies and gentlemen. I love this. All right, hold on. All right, so here's the back test currently. It went, all right, come on. There we go. All right, come on. Went from $100. It would go from $100 to 7,300, almost 7,400, right? In 1 year, average return 60, average loss 23. Now, what I'm interested to see is how the slippage is going to improve this. So let's come back here. Let's see what we have. Average slippage, median. Okay. Time of day. Worst, you pay more. Neutral, morning, afternoon, good, and then close. And then order size, opposite of paper, one contract, better fills, volume. Okay, 5 times the volume over the past 5 years, because zero DTE started getting more popular, I think around like 2022, 2020. People are just sitting at home trying to figure out what to do. I mean, what they're doing, investing in options, right? Morning session. All right. Now, let's bring in the back test. All right, bet. Now, based on the data that we have reviewed and the test we have ran, we want to actually put this to test in a back test. Review using RG and BAT and less. Terminal commands, then advise how we'll do it and how it'll work based on what we've reviewed. Well, All right, beautiful. So what it's doing right now, it's reviewing the data so we can proper understand. Yeah. And then give us an assumption, yeah, on how we could update it, yeah. With this information, bruv. What is good? If y'all do have any question, please let me know. All right, here we go. Realistic, you pay, great. The information we're meeting is the slippage model, non-existent. Uses the X, trades in the afternoon. Oh, this is afternoon session, bruh. It is. All right. Realistic, our data. Since the backtest trades, this backtest trades in the afternoon, so I just have to tweak it a little bit, but nonetheless, let's keep going. Our analysis shows that afternoon fills are better than mid. The currently backtest is actually conservative. The real results might be slightly better. We need to add a okay. Okay. You want the results as is? Let me give you the results as is. Review the results as is. Shit. This is 2023 RS exit. 2023 RS exit. Use Parquet tools and other terminal commands to review. Then let's discuss best course of action with this context. Bet. Guap. All right, now it's going to extract and find. And then proper being able to review. Yeah. Proper. You know what I also need to do that I forgot is but I'm going to. Now we guap. So it's reviewing to be able to understand, all right, this is what it looks like right now. Calculate the slippage impact on the back test. All right. Here we go. So the current back test, just keep this in mind. Matter of fact, let me just throw this in the chat real quick so I can keep it in mind. This is before we add the slippage model information, right? So before we add the slippage model info, this is what the metrics are. So let's see why backtest is already conservative. We get in at ask, we exit at the bid, we trade in the afternoon. Our data shows afternoon fills are a little bit better. The backtest assumes that worst case fills, but real afternoon fills are actually better. Add the explicit and then filter by spread. No. Okay. Yes. That's what I want. We want to do the following. Are you able to do so? So make sure that we get proper logging and tracking so we can gauge the effectiveness of this, right? Well, all right, come on, stop tripping. Once ready, proceed to update the backtest. All right, I think this is going to be interesting. And I'm really curious to see how this will play out. Now, before we even added the slippage, right, to our model, it's like 100 trades, 7,300, and this is afternoon trades. So this is my first time even creating a strategy that trades in the afternoon, because my rule of thought, because mainly we're doing 0 DTE, options that expire the same day. I want more time in front of us, not less time, right? But I'm seeing that these moves are explosive in the morning, in the afternoon, excuse me. But I'm also limiting our risk, right? But I still think this is an advantage in order to get it to be a little bit better. So let's see how it performs, and I'm interested to see how well this works. If y'all do have any questions about what I'm doing, how I'm doing it, why, let me know. Right now, I'm using Claude Code, and with inside Claude Code, I'm using the Opus 4.5 model. And what it's doing right now, it's going to update our backtest in order to add the slippage model details that we've gained from this paper. Now, I've been using this paper as a basis of what we're going to be doing, right? I got this paper from Google Scholars. And what is Google Scholars? A place where you can come find academic papers to be able to help you flesh out whatever idea that you have, right? The reason I love Google Scholars is because these are people that has invested 10, 15, if not 20 years to be able to think about one particular idea and how well to do it. So these 4 individuals have got together and was able to come up with theses and theories, right, for slippage. And now we're putting those theories in test right now with our back test. So that's what we're doing. If y'all do have any questions in the interim, let me know. But I am interested to see how this is going to work for the back test, and to see if it's going to be better, right? I don't know. Let's see. But we're going to get tracking. We're going to get logging. I already gave you what it is before. So let me just write this. This is it. This is before the slippage model addition. Now let me add the slippage analysis section to the output. First, let me find where the results are printed. Go up, down. All right, here we go. I'm not going to hold you, man. If we can crack this, like, we are on the verge of being able to give our strategies like real edge, because you don't know how much fucking time slippage has hurt us, right? What is slippage? Before you even get into a trade, you're down 5%, you're down 8%, and you're asking yourself, why? Slippage. Slippage is the difference between the price you expect to pay and the price that you actually pay, right? We expect to pay $1, but we actually pay 108. Damn, bruh. I just $8 off me, bruh. Slippage. So if we can control for slippage, right? If we can, all right, we are able to run our back test now. All right, remember the first back test before slippage, 240 trades, I think 7,300, about 60%. Now we're going to run it, and we've added slippage to it. So let's see how well it works. Right, so let's see if we are able to get an improvement. The back test is going to run by itself. I want it just to run quickly. Then we're going to review the data on the back end. So give it about another 10 or 15 seconds. The back test is going to finish. Then once it's done, we can actually review and get it in. All right, beautiful. Let me just scroll all the way to the top. Holy shit. Y'all, we went from 7,400 to 12,000. That's crazy. 60% win rate to 67 round up, right? Let's look at this impact, the slippage impact. Raw P&L, no slippage, 10,000. Adjusted P&L, right? Total slippage impact, average slippage per trade, normal, wide. Insight, the slippage reduced profits by 1350. Best performing tier was very wide. Real life, okay. This is interesting, y'all. So this actually helped. Let me see. All right, let's take this. I think we found something, ladies and gentlemen. Review and let's discuss. Damn, I'm gonna need it. And what I've been doing too is I'll have this is what we done yesterday, right? Is like I'll have it create a little white paper on what we've done so I can keep track of it. So I'm gonna have it create a white paper on the slippage so far. So when I go to the next model, like, or the next session, it's not tripping. All right, wait, this is backwards. The output says slippage reduced profits, but the adjusted higher is higher than the raw. Where is applying price improvements, which means we pay less and we get more. This is adding the profits, not improving. The insight message is wrong. I understand that. Okay. A few things. Wait. You know what I want to grab? Let me go ahead and grab our data real quick. Let me just go ahead and grab our data so people can say I'm not Capiana. Right? Then here it is after the slippage model added. Damn it. Hold on. Y'all really got to give me more room, bro. Like, to limit me. Here it is after the slippage model added. Man, this is goo-wah. All right. Boom. A few things. First, fix the insight message and make sure there are no other issues. Then we need you to create a white paper of sorts, building on the work of right, and add it here. Make sure to not miss a detail, any details, and add what we have learned and tested before we proceed. Well, all right, bet. Like, this is actually a chef's kiss, homie. A chef's kiss, man. Oh shit. Should I just giving them like all of it? Pause, but hold on. The logic is inverted. Don't test. Don't test. Again, add what we have learned and tested and validated and call this part 1. Da-dum, da-dum. We've actually improved stuff. So I'm just waiting for it to output and to give us our research paper. And then once we have our research paper, I'll be able to continue the work, fam. We're doing diligent work, bruh. Diligent work. And if there's anything that seems confusing or you need more clarification on, please let me know. What I'm doing right now is fantastic stuff. I'm not going to hold you. This is going to allow us to really take our strategies to the next level. Building on the work we did yesterday with that realized skew. If you haven't checked out the video, I would definitely implore you to do so. Matter of fact, I was saying that I was going to get the link and I just grabbed it. So if you do need it, there is the link. So if you haven't already, please make sure you check out that Realize SKU video, because it definitely builds on the work that we're doing today. And again, I'm super geeked about this because this is really going to allow our strategies to have a little bit more edge, to have years, if not decades, of test and academic theory behind what we're doing. So I'm just not pulling it out of thin air, right? And sometimes, yeah, it is nice to be able to use the AIs out there, but as we all know, AI can hallucinate, right? So that's why I like to be able to ground our work in academic research. And then once we've taken that, we're going to test it. We've tested it. Now I'm just building that white paper. Then we're going to continue our work, right? So we're able, just a little recap, right? We're working on slippage. What is slippage? The difference between the price that you think you're going to pay and the price that you actually pay, right? If you don't understand what slippage is, then you're just throwing away your entire algo. And what we're doing here is we're taking the time to be able to understand what has gone well, what has worked, right? And that's what we've done. And right now we're back testing our beautiful. All right, section, literary review, data, empirical results. Okay, beautiful. Research paper, our 2020 firm. Yes, we're gonna run more tests, right? Let's update the back test so we can run it on 2024. And I knew it was gonna compact. I was just like, all right, bet, just go ahead and get this out the way so we can continue the work. All right, we're goo up. I just wanted to make sure, because the one thing about Anthropic, boy, they will throttle your ass if you don't keep an eye out on it. Let's say massive rejection, fam. Massive, massive, massive. This is just crazy. Crazy, crazy, crazy day we've seen today in the market. And this is actually going to help us, man, in that context, like allow us to be able to actually trade better, right? And automate our trading, take our hands off, and just all we got to do is click a button. And then, oh, shit, you just made me a couple $100. That's what's up. Let me give you a high five, right? Let me give you some new code. Instead of a high five, let me give you some new code. Let me go ahead and debug you real quick. What is... So a candy is to a human as to AI is to what, right? So like if we do something good, bet you give us candy, you like, all right, I mean some people, give me a bag of fries. Is it a bag of fries or just an order of fries? I don't know. Give me fries and I'm Gucci. That's like my hoorah, I did it, right? Fuck that candy shit. I'm more of a salt. I don't know how I got here. All right, I can stop. We're reviewing it, and I want to make sure that we're going to be running it on 2024. Yep, update the back test so I can use 2024. Beautiful. I think what we should do is toggle it off, get a framework, toggle it back on. All right, just don't fold, bro. I was about to say. Now I need to update the line to use the year index and the print statement. Now I need to find where the year index is used in the backtest function. Excuse me. I need to pass the year offset to the function. Let me test where the where the function signature is. Pattern. Beautiful. Year offset. Get the fuck. Now let me update the run call. I thought it was like, I didn't see update. I just said run. Now I also need to update the stock file is located. Don't fold, bruh. The stock file is already loaded via stock of the day, which is the full list. Okay. I was just going to check. Wait. What the fuck did you do? Wait. What did you do? This strategy was QQQ. What did you just do? Holy shit. Oh my goodness. This artificial part of the AI, bro, I could cut you out. I changed the back test from QQQ. Who told you to do that? I did not ask you to change the back test from QQQ to SPY. We still want to use SPY. Well, still want to use QQQ. How can we do so? Oh, it supports both. You fucker. I'll revert to Q. No. You said it supports both. You said it supports both. Double check, and if that's the case, do QQQ 2024 so we can run it. I could really cuss you out. I did not tell you to do that. I mean, it's kind of cool. I can still cuss you out. Kind of cool, but I can still cuss you out. Nobody told your ass to do that. Ah, shit. Toggle the slippage off so we can get a baseline first before running it. Where is it? Who is this? Is data. Okay. We repping data. All right, none. And then Python. All right, now we're running our back test without the slippage model on 2024 to see how well the strategy does without it, right? Just so we can get a baseline. Then once we get the baseline, flip the slippage on and see if there's an improvement, if there's any degradation, right? And then figure out why. That was interesting. Okay. When things just fall out of nowhere, I'm like, all right, is there a ghost here? Or I'm sorry. Let me shut up. All right, so let's just a quick review. It went from $100 to $14,000, so that's kind of good, right? And the win rate is 69%, right? Trades exited via RS. Okay, that's what's up. So we're Gucci. So I love this as a basis. So here's the baseline. So let me take this. Let me go ahead and drop it in the chat so we can have our baseline. So I want to say is 2024 baseline. And then let's go ahead and run it with the slippage on so we can review. Don't fold. Ah, fuck. I know it was going to. Bruh, I knew it was going to fold. Damn it. Hold on. Data. No, I don't need a folder. I need a file. Paste you in there. Yep, you froze. Nope. All right, let's go ahead and close this out. Sometimes when I try to paste those large data files or those file outputs in there, it freezes. So Anthropic, if you're listening to this, if you're listening to my stream, thank you. Fix it. Thank you, Barbara. Review using grep and awk to get the baseline. Then let's turn on the toggle for spread based. My fault. I can copy you. Go ahead and throw you on. Oh, you said slip it. Nope, it's in data now. You should be turned on. All right, beautiful. Let's go ahead and run it. So what do y'all think is going to happen? Is it going to get better or worse, right? If I'm just deducing, right, from previously when I think we went from like 7,000 to 15 to 12,000. So it got a little bit better. This was in 2023. Now we're running it in 2024. And I want to see what the impact was. So this will be interesting to see what happens and how the slippage model that we were able to take from Google Scholars, right? So academic paper that was researched for almost a decade. Only caveat, it was research. It was released back in March of 07. So I had adapted for early. Oh, holy shit. That's crazy. So it went from what was that, 69% to 72%. It went from 14,000 to 18,000, right? So we did get better. All right. Now remember, I just can't paste it in there because I don't want it to freeze. So I want to say is with slippage results. Review to understand what happened when we added the slippage. RG and BAT, and less to understand it well. I mean, I really think I'm making great strides at this. I am not going to hold you. We're seeing consistent improvement, right? After slippage. Not gonna hold you, fam. It got better. Keep finding the slippage model added 3,600, 20, almost a quarter better. Very wide spreads contributed 1,500 price improvement. This matches our 240 trade study, where wide spreads actually gets better than mid price. This is counterintuitive, but validated research that market makers give price movements on widespread options. Okay. Now what I want to do is put this, we tested this on afternoon. Now I want to test it on the morning. I do have a strategy that I can use for the morning. Who am I going to use? You know who I'm going to use? The bot we made yesterday. Where is it? Shit, why can't I find it? PB&J V2. So here's the bot we made, a bot we actually made yesterday from a strategy, right? This is the 1, 2, 3 pullback strategy, right? That we created step by step. What I want to do, I want to add the slippage model here. Now, let me show you what the strategy is doing right now before we even added the slippage model, right? Let me just open up another one so we can proper compare. All right. Oh, fuck. Conda, activate, algo, baby. That's like your little speed bump. Bro, put me back on. Turn me on. So you can see This one runs a little bit slower. Like all of my, I'm trying to get it where it can be a little bit more consistent. So y'all just bear with me, fam. So the strategy went from $100 to what is it? 19,000 without what we're about to do. Now, check out what we're about to do and see what the strategy is about to do. Big bruh. And this is using who? SPY, not even QQQ. So I'm using a different asset, and then we're going to be using morning data. Let me just make sure you're in the morning and I'm not like pump faking. Yep, 9:30 to 11. Beautiful. All right, now we're going to review, and before updating, need you to understand the strat. Here it is. Use RG and BAT to get it. BATO to get it, then advise before updating to add the slippage model. I'm not going to hold you, like we're seeing great thing. What strategy did I? Oh, it's Gabby. Never mind. This is still cool. This is still GUAP. I'm still going to use this. I think I may even create a bot for this one. I'm not going to hold you. Like if it gets ridiculous, I think I may even do it, because this strategy right now is going from $100 to 19,000. Who won't want an algo that does this for you, right? All I got to do is turn it on. 75% win rate, 3 out of every 4 you're winning. And this is before we add this little secret sauce to it. So I'm interested to see how it's going to improve now that we're going to add this little secret measure that I got from Google Scholar. So it's open to everybody. But are you going to do the work to find it? Already has the basic entry. Okay. All right. Let's do it. Well, let's do it. All right. So as y'all can see, I just want to review the strat a little bit more. Average win is $130. Average loss is 76. Average hold time is about 2 minutes. This is the way we're exiting right now. Risk averse, and our RS or realized skew is what I went over yesterday. So if you want to go check out that video, I did drop it in the comments so you can see how that works. So I'm interested to see, bruh, how this is going to work out for us and how well the strategy is going to adapt now that we're adding. Number one, we're using it in the morning because we first use it in the afternoon and it's still a chef's kiss. So I may even create that bot. I'm not going to hold you. And that would be my first little afternoon hunter, because normally after 1 you're done. But if this slides, talk to me nice. Talk to me nice. So I want to say like in another 40, maybe 20 minutes or so, we're going to wrap up this stream. Nonetheless, where I was able to get it accomplished what I wanted to, right? And that's being able to test out this slippage model, being able to validate it across different back tests, being able to validate just that thesis by itself, right? And we kind of did. Now this is like the next level of being able to test to see how well it's going to work in the morning, number one, and how well it's going to work with one of the most liquid ETFs out there, being SPY, the S&P 500, top 500 companies within the New York Stock Exchange. All right, let me just go ahead and grab you because I know I'm going to need that. And then let me go here. And then we can clear. Then we can paste. Then once we have it, we're going to be Gucci. All right, get me right, get me right. Swooping. Let me verify the syntax is correct. You know it is. Get me right. Bet. Holy shit. Y'all see that? That's 18,000? That's 79,000? Hold on. Hold on. Hold on. Hold on. 91%, fam. Okay. I just want to make sure I'm not tripping. Okay. Y'all see what I see? Does that say 265,000? Was that 2 million? 1, 2, 3, 4, 5, 6. So $265,699. It went from, it was okay before, but now this is over the top. Like, we slid. Hold on, bruh. Hold on. Hold on, bruh. Hold on. I'm not even gonna try because I don't want it to freeze. So what I'm gonna do is just go ahead and put a guide date here. Use bat. I gave it a before. Did I give it a before? I don't think I gave it a before. Okay. Turn it off so we can get the baseline. I'm just gonna get the baseline real quick, but we know what the baseline is. Like, I'm just gonna paste it in the chat so I can like proper get it. Okay. Beautiful. And I don't want to act like I'm, because if this is what I think it is, I'm just gonna make this bot like now. Cause what is the point of waiting? $100. All of our strategies start at $100. Okay, 1,600, 4,800. Okay, that's not bad. Okay, this is still ridiculous. We still did something better. Something is still better. This is not what it was. It's still on. It's still on. Okay. You can turn it on. Shit. Let me see if I can find it. Let me see if I can find it. Is this it? I think this is it. Hold on. Where you put, okay, hold on. I'm gonna figure this out. So gross reason, P&L, exit, hold time, signal, price. It definitely grew. Review using BAT and RG, and let's discuss. Bro, even if it's marginally better. Oh, 2023. 2023. But you updated like 10 times. Y'all see that? That's crazy. This strategy has insane performance, bro. The slippage model adds a small but consistent boost. Want me to run the baseline? We did. And it started out at a fraction of that. Well, if you can see this, does this tell me what it is? Yeah, even if I use this one, 19, yep, this is it. See, using BAT and RG, and let's discuss. Bro, it went from 19,075% before to 20. This is just outrageous. after. Outrageous, fam. I mean, I can appreciate it. Thank you. 13.5 times difference. Whoa. This is suspicious. 13 times. The baselines using the O configs, which penalizes every trade. The new spreads give price improvements on Y spreads. The 13 times difference is too large for slippage. The position sizing is compounding as the balance grows. Position sizing gets larger. The slippage is hurting every trade versus slippage is helping some trades. The compounding effect exploded. Bottom line, the spread-based slippage model is more realistic and shows the strategy performs even better when accounting for the actual market behavior and the price movements on wide spreads. All right, let's update so we can run on 2024. What did we just run it on? Is this 23? Shit, I don't even know. This is 23. Get me right. Matter of fact, let me just copy you real quick. Because the video is getting a little bit too long, I'm gonna save the bot for the next time. But what I'm gonna do is run this back test though and see how much better it gets with. And this is 2024, right? We just ran it on 23. This is 24. Okay, $100. In March is at $1,200. By May it's at $3,800. Okay, by August it's 11,000. It's not as 43,000 in 2 months, almost $30,000. I blinked. 171,000, bro. That is not bad. That is not bad at all. We found something. 2024 results. Use RG and BAT to review via terminal commands. Then let's discuss. Well, we found something that's going to help our strategies. I love it. I mean, yes, but it's still over 100 grand, bro. Just on being able to make sure that our slippage is a lot better. That's what I really wanted this stream to be focused on, is making sure this strategy is a beast. But that's the first thing. This strategy is a beast. The morning sessions micro pullback patterns with the RS filter is printing money. With the wide spreads, total slippage impact. Man, this is crazy. Over 80% win rate, over 100,000, in some cases over 200,000 return when you're starting at $100. Average win is damn near $1,000 in 2023, $800 in 24. Stop loss is 4%, very, very manageable. So what does this mean is that we are actually getting better with being able to control for slippage, fam. So what I want to do is just stop here, and then next time when we come back, we're going to be actually creating the bot. Oh, before I even do that, now I'm gonna do that myself because I need to create the white paper, but I need to do that myself. But nonetheless, this is going to be a great place for us to stop. If you haven't already, I need you to like the video, right? If you like the content, so it can push out to more individuals so they can get connected with this creative fam. This is your boy Creative.